Frontline is a leader in crude oil shipping, and today we'll discuss the outlook for the tanker market with Robert Macleod, the CEO of Frontline, and DNB's shipping analyst, Nicolay Dyvik. And I'll start with you, Robert, because you provided a strong Q1 VLCC rate guidance back in February, and despite OPEC cutting production, VLCC rates have been at $30,000 a day. Do investors have good reasons to be optimistic about 2019?
I think we've been off to a very good start of the year. It's much more balanced than it was in 2018. There was fleet growth start of the year that has been absorbed, and overall I think it's exciting. And I think we're coming into Q2 now, which I think will be the weakest of the quarters. But so far the year has seen a change in market in Q1, where the market came up in February, which basically never happens. So it shows strength, and it shows the US exports is what's going to change the market going forward. So yes, I think so. I'm excited.
Yeah, we'll come back to US exports amongst other things. But Nicolay, what's DNB's rate cost forecast for this year?
When we upgraded the tanker market about a year ago, we put forward 29,000 for 2019 and just above 40,000 for 2020. And if you look at the quarter-to-date rates, for Q1, they're about 27. And you start the second quarter bookings at 30, which Robert says is going to be the weakest of the quarters. So our rate forecast is clearly on the conservative side, it looks, and it's much due to US exports.
Robert, you mentioned the US exports. How has US crude export changed the trading patterns and ships required in light of Middle East exports declining?
I mean, you mentioned Middle East. I mean, that's a big negative. The drop in volume for the Middle East is significant with the OPEC cuts. That's now being absorbed in terms of ton miles, being absorbed by the US Gulf. It's tremendous. The impact's just tremendous. It's the voyage length is 2.5 to 3 times what the Middle East lifting will be. So you're seeing now that in 2018, the best paying voyage was going straight from Asia to US Gulf and back. So you had ships that were doing 4 voyages a year. If you go back 10 years, then ships were doing 7. So, and this US Gulf volume is not something that's just happening in the short term. It's gradually building. It's gone from 1 million. It's gone from 0 exports to 1 million, and now up to 3, and it's gradually going to keep increasing. So it's the single biggest factor in the market for sure.
Today, the only export terminal you have out the US that can handle the VLCCs is Loop. How do you see export capacity changing for the large tankers, or is lightering an equally good option?
Lightering's there now, and I think if you look at the US, if there's any place where things happen quickly and improve logistics, it's the States. Galveston being dredged, you've got Texas City, you've got Loop obviously exporting now, but I think the trend is very clear. There'll be more and more. In the meantime, the production will keep increasing, and even if any of these dredging projects are delayed, which I don't think there will be, but even so, there will be plenty of lightering capacity. So I think the trend is clearly going one way.
Nicolay, would you say US exports has surprised to the upside this year?
Yes, clearly. We put forward about 700,000 barrels a day year-over-year increase, and if you look at Q1 or so far in Q1, you see 1.2 million barrels year-over-year increase. So February and March saw about 3 million barrels of exports, and if we keep just the February-March level flat for the remainder of the year, I think we will have about 900,000 barrels a day year-over-year increase. So I think it's more likely that exports will continue to rise than stay flat. So that's probably why we're a bit conservative on our rate outlook.
Yep.
We as Frontline, we don't have any estimates as to how much they will increase. We're just seeing the trend. But what I can say is that if you look at the where the barrels are required, that's in the Far East. That's where the refineries are being built. That's where the crude is going. That's where we have the highest growth in crude demand, and the additional barrels are from the Atlantic, mainly US Gulf. So this pattern of crude moving east is here to stay.
Robert, historically August and September is low season in the tanker market. How should we think about seasonality this year? I guess the question is it different this time?
I've had this expression. This year is upside down, and as we progress into Q2, I'm more convinced than ever that it's upside down. And when I say upside down, it's a year where things will be very different. The refineries are turning around now in preparation for 2020. They're doing it earlier than normal. We, as Frontline, we have a lot of ships docking this year. As a group, as a JF group, we have the biggest docking year ever, and it's down to scheduled dry docks. It's down to additional equipment like ballast water. It's the exhaust gas systems, which is called a scrubber in the shipping world, and these things will take longer and will take capacity out of the market for the summer. So because of these two factors, I think the so-called winter market, which normally kicks in September, October, or sometimes even November, I think it will happen during the summer. So I think it'll be a very exciting year. And again, I think Q2 will be the weak one. As you mentioned, we're starting on a strong note at 30, but we're sliding now. We're going to go down. We're on our way to 20, but I think that's going to be we're going to have a contra-seasonal trend. Like we saw in February, we're going to have that again in Q2. So early winter season could actually start in the summer. That's my prediction.
A question that's often been asked us is whether crude or product will be the benefactor of 2020. And if you look at growth in refinery expansion, that's predominantly taking place in Asia and the Middle East. And the growth in crude volumes will most likely come from the US and, of course, pending OPEC strategy. So we have a rule of thumb that the product fleet is half the size of the crude fleet. So every barrel you put into a refinery, you will have twice the demand impact for product. But on the sailing distance, do you see probably then crude benefiting more, or?
I've got a simple saying when it comes to the products and the crude I think I understand a bit. The products I don't understand, because there's so much trading involved in products. The products is not an A to B market, whilst crude is much more. You have the production and you have the refinery, so that's where the crude moves. Whilst the product has to move more than once to have a good products market. But this year I think it will be interesting, because there's a lot of product that needs to be placed in a lot of ports to meet the 2020 regulations. So you'll have products start moving earlier than normal. So I don't have a clear answer as to which one will be benefiting the most, but I think the crude will benefit first, and then you'll see the products benefit afterwards. So you'll have the crude go into refineries and the products will be produced, and then they will be distributed afterwards. So, but it could well be that products gets a boost here as we go into Q4. That would not be a surprise.
Robert, we have to touch upon IMO regulations. You have taken quite a proactive approach with regards to scrubbers, not only ordering scrubbers, but also investing in a scrubber manufacturer. Can you share some of your considerations around this?
Yeah, sure. So first of all, we as Frontline, we're not investing in the scrubber company as we invest in ships and we run ships, and we're good at running ships. That's our focus. But the 2020 is such a big event that we want to be able to source scrubbers early, on time, quality, and having, rather than waiting a year, we want to be able to order one now and get one in July or August. So it puts us in a good position. And obviously, if this goes well, and the company is certainly on a good track, if this keeps going well, which we expect, then we will make money on other people ordering these as well. So that's a bonus. But we are in the shipping business, we run tankers, and that's our main focus.
We tried to quantify the impact of all the disruptions that will take place in 2019, and many focus about 2020, but in 2019 you will have many disruptions taking place, and we calculate that about 2% of fleet capacity in crude will be taken out in either ballast water installation or scrubber installation, and also cleaning of fuel tanks. So if you could share you will do it in Singapore at Keppel, but if you could share some of your considerations or planning around how much time it will take to retrofit a scrubber, and also the difference if you're going to do it in connection with the docking, or if you just do it in between the docking schedule.
So far, we as Frontline, we've only sort of lined up the scrubbers for the scheduled dry docks, and there we expect 1 to 2 weeks additional time. If we do outside of the schedule, then it's probably going to be 3 to 4 weeks. It's a substantial amount of time. As for the estimate, again, we don't have our internal estimates. We leave it to your analysts to do that for us. And what I can say is that the 2% to me sounds low. And the reason why I'm saying that is that this year there will be so much docking activity that this is bound to lead to delays. So you arrive at, say you're scheduled to be in on the 1st of July, you arrive there, the ship before you will be delayed, and I think you'll create bottlenecks. You also have deviation going to the various docking facilities. So I don't have a percentage, but 2% sounds low to me, and this what you're describing is why I think this year will be an upside down summer. So early winter market is my prediction.
Would you, as a group, have an advantage doing everything in Singapore with Keppel, or how do you differentiate between Keppel, Singapore, and if you were to do it in China?
Certainly, we have, as a group, there's no doubt, with more than 250 ships as a group, and then I'm not counting offshore, and I'm not counting rigs, then you're 500 plus. As the group benefit is substantial, there's no doubt, and getting the docking for space and getting the right price, we're in pole position for sure. So on the tankers, we're doing all in Singapore. On the bulkers, we're doing a lot in China, but having the amount of dockings we have, if we have one ship delay, one ship move forward, we can swap around, and it gives us great flexibility for sure.
And if you were to touch upon how you plan the fuel tank cleaning into, I guess everyone would like to do it as close to year end as possible.
Yeah.
But how is that planning developing?
No, we're spending a lot of time. We've got a designated team doing this. So we'll start doing this in Q3, going into Q4. If a ship's been running for 10 years on high sulfur fuel, you'll have sludge. The bottom of the tank will be full of sludge. You need to get that out, because emptying a tank and then putting the compatible fuel in will then mean that it's not compatible anymore. So cleaning will be required. As for the time, we don't know, but there'll be a big job, and you can't do it too early, because then you'll have to start running the diesel and running the expensive fuel earlier. So it's a timing issue that we're very aware of course, and spend a lot of time on.
We've calculated that if you take all the crude tanker ships that is not having a scrubber and they spend 5 days cleaning the fuel tank, you will have about a 4% increase in utilization in Q4. Is 5 days low or high, you say? Or can you do it while you sail? Or
you can do it while you sail, part of it, but there's a lot of manual work here. You have to have people go in and dig this stuff out. So in the worst cases, some cases you can do differently with chemicals, but we don't know yet. It's my not very clear answer, but it will certainly have an effect, and it will happen in the quarter where you'll see the world moving more oil than ever before. So Q4 will be huge, I think.
Let's move on to scrapping. According to Clarkson's, 32 VLCCs were scrapped in 2018. Year to date, it's been only one. Is there a lag in the statistics? So, and what should we expect from 2019 and 2020?
This is 2018. There was scrapping 32, and there was also ships going into storage and leaving the trading market. So my numbers say that 39 ships were delivered and 39 left. So you had 0 fleet growth, and that's why we come into 19 with a far better balanced market. So far, ships have been making money. When you make money, then there's not going to be scrapping. That's a simple logic. But in the summer of 19, again, we go back to this all the time, but it's very important. It's upside down because of the docking, because of ballast water, and because of scrubbers. If you look at an old ship, if you want to get all of this equipment on board and do some steel work in various, you can have a $10 million bill to get the old ship running. And I think that one thing is having the money, another thing is willing to spend it. So I think you'll see scrapping, not at the same pace as last year, but you'll see scrapping this year as well. And it'll not be a big number. I'm not going to guess, but let's half of the deliveries being scrapped could be the number. Let's see.
If you convert the crude 2020 order book to VLCC equivalents, I think we count about 63, and there will be about 40 VLCC equivalents that turns 20 years in 2020. So the question then is if people will or owners will scrap a 20-year-old ship. Could you share some of the costs associated to comply with 2020, both from a fuel consumption perspective? What's the disadvantages on the cost side?
I think the simple figure, in looking at the Frontline fleet, our fleet will have to, our fleet makes $45,000 a day on a VLCC, then the 20-year-old or 17.5-year-old, I think is probably more relevant, will cover OPEX. So we will make 45 a day, and they cover OPEX. So the difference is huge. And we've had historically, there's a two-tier market between the old ships and the modern ships, but that spread is now going way out. So it'll be a huge difference. And with a diesel price going through the roof like we expect, then and I don't think the older ships will install a scrubber. So the fuel bill will be the single biggest factor that leads to this differential.
And in terms of ballast water cost and docking cost for a 20-year-old ship on a VLCC, what would you say?
During my time at Frontline, the lowest bill has been about 2 million, and the highest been 7. So let's call it between 3 and 4.
Yeah. Okay. And when talking about new versus old tonnage, many talk about the cost disadvantage, but there's also a commercial point of view to take care of. How do charterers treat an old ship versus a new ship in the market?
There's a very clear trend. Every year the trend is clearer that 15 and younger are preferred, and that now China is one of the leaders in terms of taking younger tonnage only. If a market's very strong, then this softens a bit, but the trend is very clear that the lifespan of a ship is coming down, and 15 is over 15 is a different earning potential than the over 15. So on our ships, we don't have many ships now over 15. It's only 2, and they are leased ships from Ship Finance. But on those ships, we basically only stay in the Far East or the Asia region. We don't take them to the Atlantic because it's very difficult to trade them. So the Atlantic market is the most exciting market, and that's where the modern ships will make the most money, I expect.
Or if you were to quantify how many cargoes are a modern ship shown versus an old ship?
I'd say if you have 10 cargoes in the market, then the old ship will be able to do 2 of them.
When it comes to
and a few years ago, then if you go back 5 years, it was probably 5 or 6. So it's going down by 1 every year, and then as you go into 2020, then
left.
let's say there's going to be 1, and then in 21. But at the same time, the lifespan of the ship is coming down. So we need to make more money during the years that we run the ships. It's obvious.
Yeah. When it comes to new build prices, they have been quite stable over the past 6 months, and we have seen some large orders of LNG tankers. I guess investors should always be a little worried about a flurry of orders coming in. What does the yard capacity look like?
I mean, you're right. We're very worried, right? It's the same in every cycle. We build ourselves into the next down cycle. Yeah. That happens every time. So as you say, LNG is one. Big container ships is another. There is activity, but to answer your question in terms of capacity, the capacity is there. If people are willing to pay, the capacity will certainly be there. So that is for sure. But what we're seeing in the market now is that you can order a ship delivery in 2 years, or you can buy a resale delivering end of 19 or into 2020. And there are resales available. And one thing that's pretty sort of everybody agrees on is that we're going into a stronger tanker market. Some are very optimistic, some are super optimistic. But generally, there's an agreement. Because of all the crude that's coming into the market will be stronger. I.e., if you have the choice between taking a ship delivering in 19 or 20 versus ordering a new building in 21, then you're very likely to take a ship delivering soon. So I think that you need to have activity on the resale front before you see a flurry of orders. That's what my comfort is in terms of lots of orders coming in. And we've seen so far this year, very little activity. So I'm hoping that this will continue.
Yeah. I guess other pretty obvious risks are the trade war and also weaker economic growth, which have been sort of highlighted over the past few weeks. How resilient would you say tankers are to these risks?
I think no shipping market is resilient to it, but the tanker market is more resilient than most. Obviously, we've seen all that's happened on the dry cargo market and how big an impact it has on the market. But the crude demand into China is strong. The cargoes are moving. One thing we're seeing now is that Saudi are sending less cargoes to the US, which is a negative, and hopefully that will turn. I think it will turn in the second half of the year and be another positive driver. But overall, I'll say the tanker market is more resilient than most other shipping markets. tanker market. So I'm not concerned about the trade war part of it too much. What I am concerned about is a global recession. That is the big. That's what would take all my positive factors and kill quite a few of them. So that is what we need to look out for, because if that happens, that will certainly change the picture.
As a final remark, are you more positive now than 6 months ago, or how has your view changed over the past 6 months?
I was positive 6 months ago as well, but what we saw happen in Q1, in February especially, with the US exports, and also the number of negative factors that are actually in the market now, prevailing in the market. Lack of, as I said, with Saudi, the lower volume there going to the US is negative. I think OPEC volume will return. So overall, the tanker market is more balanced, so I am more optimistic than 6 months ago. It looks to be a very exciting year, and I think it's going to continue to be very exciting going into 2020 and possibly 21. So hopefully we're right in the prediction, because we are certainly in a good position as Frontline, for sure.
All right, that wraps it up. Robert, thank you so much for joining us, and thank you for watching.